if Bitcoin continues to grow at the rate it generally has, it clearly is chipping into some demand for gold and silver, because now as a capital allocator, pre-Bitcoin, I'd have gold and silver. Now I can say, okay, well, gold, silver, and Bitcoin, right? And so what percentage do I want to have in either? So it kind of fractures the market share a little bit.
Lyn Alden, the founder of Lyn Alden Investment Strategy, outlines how the ongoing Federal Reserve policy of quantitative tightening has postponed a recession. Lyn suggests investing in scarce assets such as gold, Bitcoin, and high-value properties. The connection between Bitcoin and gold goes back to Bitcoin's origin. Bitcoin's market value is frequently matched up against gold, which boasts a total worth of $12.8 trillion. Best-selling author Robert Kiyosaki, known for his book Rich Dad, Poor Dad, believes that gold, silver, and Bitcoin will experience a sharp rise if the economy crashes. According to Alden, by approximately 2025, it's plausible that circumstances could come together to create conditions favorable for another significant increase in the value of Bitcoin, often referred to as a bull run. Alden suggested that cultural elements might play a role in shaping the desire for precious metals such as gold, particularly in places like India where there exists a deep-rooted historical connection to these assets. Gold on Tuesday dropped to as low as $1,895.50 an ounce, its weakest level since in June, as benchmark 10-year U.S. Treasury yields hit an almost 10-month high, making them more attractive than non-interest-bearing bullion. While Bitcoin price has been stagnating in the last few weeks after a couple of pikes. According to predictions, Bitcoin is still volatile, which leaves investors wondering if it's the right time to buy. Alden noted that, in a broad sense, the majority of on-chain indicators for Bitcoin appear highly favorable over the upcoming 2 years. Let's direct our attention towards the video. Before we proceed, make sure to subscribe to the channel and hit the bell icon for more updates.
Generally speaking, in the next 2 years, most of the on-chain indicators look very attractive for Bitcoin. They look similar to how you look after a major bottom, like the big bottoms it has like every 4 years or so. There's a supply flow halving coming up. The on-chain indicators, like the supply side is very tight, meaning that the percentage of coins. So during a bull market, a lot of long-term holders sell some of their coins into the bull market as new entrants come in. And then during bear markets, a lot of these kind of like fast money people get out. And a lot of these long-term holders reaccumulate coins. And so a lot of coins get held by very tight hands that really know what they're holding and don't plan to give it up unless they have a massive price increase. And so generally you kind of run out of sellers. And there are people still buying, and that kind of sparks the next bull run. In addition, I expect the next 2 years. So we've had falling liquidity, falling, say, economic deceleration, so PMIs and things like that. Generally, Bitcoin is correlated with liquidity and PMIs. And so I expect the next 2 years, we're probably going to have another upswing in those. So we have a combination of very tight on-chain dynamics and then another liquidity or reacceleration cycle. I don't think we're there yet, but when we look out to say 2025, I think we're probably going to be due for another Bitcoin bull run. I mean, that's subject to various things that, liquidity crises or geopolitical issues or things that could derail it. But that would be my base case, is that I think we're in that more attractive phase of the Bitcoin cycle. Historically, over the past century, that's been the answer. Generally, if you take the U.S. money supply growth and you subtract the annual gold supply growth, you generally get the answer for what has gold appreciated over the past century per year on average, that differential. Now, obviously, every year it's not going to be that smooth. There's going to be a decade where gold is flat. People are, they're distracted elsewhere, and then it kind of all catches up at once in another decade, right? That's generally how we've seen gold operate. But on a long-term basis, that generally tends to be the case. The one challenge to think of is that you have to look at the different things that people can store value in. So you have to say, okay, there's gold, there's real estate, there's Bitcoin, there's art. So you kind of look at that whole market and you say, okay, that market is likely to kind of grow in line with money supply over the long run. And then the question is, among those different competing assets, which ones are going to eat into market share of others? Right? Is something going to get more people interested in gold? Is something going to get more people interested in Bitcoin? Is something going to get people more interested in focusing on real estate? If and you can make different arguments as to why. If India's GDP doubles, culturally they very much like precious metals. They have a long track record of that. They're going to probably want more precious metals.
An increasing number of economists, including the Federal Reserve's own staff, are predicting the U.S. will escape a recession, though it'll be well into 2024 before anyone can be sure of it. Fed Chair Jerome Powell says he expects the central bank to navigate a path where the U.S. economy expands with inflation rates falling back to the 2% target, though the task will be challenging. According to a new working paper from the University of California, while U.S. inflation has come down significantly from nearly 9% to 3% and unemployment continues to stay low, it will be challenging for the Federal Reserve to reduce inflation to its target of 2% without significantly raising the unemployment rate and possibly sinking the U.S. into a recession. In the interview, Alden mentioned that having deficits of 6 to 8% of GDP even before a recession begins makes it somewhat difficult to experience a recession when there's such significant pre-stimulation happening. Let's direct our attention towards the video.
When the Federal Reserve initially started setting on their policy of tightening in early 2022, in spring I talked about recession in my newsletters, and that whole year was indeed terrible for asset prices, and it was most economic rate of change indicators were slowing down all throughout 2022. Now, what started to change in early 2023, and to some extent in very late 2022, was that this ongoing tightening by the Federal Reserve, even though it had killed certain industries, or at least killed certain asset prices and certain types of inflation, the fact that it was now resulting in larger deficits because of that heightened interest expense. Basically, the federal government debt had given enough time to start maturing and getting refinanced at these higher rates. And Federal Reserve's operating at a loss. They're the opposite of ExxonMobil. ExxonMobil's assets pay higher interest rates than their liabilities. The Federal Reserve is paying higher interest rates on its liabilities than it is earning on its assets, and that's money that's pouring into the economy. And so, as these various liquidity effects started to actually impact it, we got this weird environment where, so throughout 2022, the deficit was shrinking as a percentage of GDP. We had fiscal contraction, but in 2023, it started widening again. And that's in large part because of interest expense. So by pushing down asset prices, at least for temporarily, that hurt tax revenue. And then it also increased interest expense. So both on the budget, on the revenue side and the expenditure side of the federal government, it increased deficits. And generally speaking, when you have a recession, governments increase their deficits, either because their tax revenue collapses, but they keep spending, or because they also increase spending as a form of stimulus. Now, before this recession could even materialize, we're running, $1.5 trillion or $2 trillion deficits, like, 6 to 8% of GDP deficits before the recession's even here. And that actually, it's kind of challenging to have a recession when you're pre-stimulating to that degree. Mm-hmm. Now, you can still have one, especially in real terms. That's how recessions are defined, but it extends the negative impact you need from the private sector in order to have a recession. It keeps kind of pushing the can down the road. It makes it so that inflation falls a little bit less quickly than we think, and it makes it a recession is kind of pushed out for a period of time. And so that's kind of where we find ourselves right now, where monetary policy is trying to be very tight. And like I said before, in certain areas, it certainly is. Commercial real estate, junk-rated companies, unprofitable tech companies, these have been a truly, disinflationary, deflationary type of area.
Bitcoin's claim as a superior store of value is not just theoretical, it's supported by empirical evidence. When we contrast Bitcoin with conventional assets like bonds and gold, a notable disparity becomes apparent. This connection between Bitcoin and gold has its roots in Bitcoin's inception. In the scenario of an economic downturn, it's projected that all three gold, silver, and Bitcoin would experience substantial value growth. This concludes our discussion for today. We encourage you to share your views in the comments section. If you found this content informative, please give it a big thumbs up and subscribe to our channel for the most up-to-date news and videos. Thanks for joining us.